Fellow Ghanaians, a very good evening to all of you, and thank you very much for joining us here on Upfront on the JoyNews channel. Today, the 17th day of June, 2021. So we know that the Finance Minister has been in Parliament. He's been answering some questions on how much government has been spending in paying independent power producers from 2017 to 2021, close to 1 billion Ghana cedis. But also there's been a sad news in Zambia, the fact that the man who led Zambia to independence, Kenneth Kaunda, we're told passed on today, and so we say his soul rest in perfect peace. But for us here in Ghana and for us here on Upfront on the JoyNews channel, today our focus is on the financial sector. In November 2019, 53 fund management firms had their licenses revoked. Over 100,000 of you made claims. Now, validations were done. You wanted some 11 billion Ghana cedis total claims. After validation, 8.3 billion. But every now and then, as I have discussions on the Super Morning Show on Joy 99.7 FM, some of you will send messages and say, we have still not been paid. We have still not received any money. Contrary to what you're told all the time, that government intends to pay everybody and ensure that for all of you who invested in these fund management firms, you don't get to lose any money. Tonight, we want to do a very simple exercise. We want to find out how many of you have been paid, what number is outstanding, how much has been paid, how much it's been outstanding, and also get to find out more about reforms being conducted at the Securities and Exchange Commission. We want to find out what they have done so far and what they intend to do in the future. What are some of the innovations that have been brought up since the financial sector cleanup started? My name is Winston Amoa, and when I return after these messages, I'd be introducing my guest. And then we zoom straight into the conversation. And I know this is a conversation you would want to be part of. In fact, I want you to be part of this conversation. And so why not join us on Twitter at JoyNews on TV, tweet at us. We'll get your tweets and ask all those important questions. Of course, we're live on Facebook and on the JoyNews page. So get there also and post all your questions. I promise you, I would ask those questions on your behalf. Stay with us. We'll be right back. Right, so welcome back, and thank you very much for staying with us here on Upfront on the JoyNews channel. Like I promised you, this evening, we're joined by Paul Abebi, who is Deputy Director General of the Securities and Exchange Commission in charge of finance, and Deborah Jenfra is also Deputy Director General in charge of legal at the Securities and Exchange Commission. You're going to help us understand, all the things you've been asking, all the questions you've been asking as you say, I haven't received my money. And you tell us, well, government is not telling us the truth. Well, we say the Securities and Exchange Commission should be answering questions, and they're here to answer the questions. Gentlemen and lady, good evening, and thank you very much for joining us.
Thank you.
Thank you, and pleasure to hear.
I believe all of you are doing well. Great. And I'd like to start off with you, Paul. Because, I've been checking your website. You've talked about, the full bailout, partial bailout, how much you have paid. I see when it comes to the full bailout, you've paid less than 1 billion. Total amount, 2.5 billion. What is the challenge? Why are you unable to pay all the 2.5 billion?
Okay. So the bailout was done on two principles. One is for firms where we've obtained full liquidation order, we started the bailout process on the basis of those firms. And that was the government policy at the time, to obtain the liquidation orders and ensure that the legal basis for assuming those assets is secure. But towards the end of last year, government also initiated a partial bailout scheme. So the partial bailout was to address those that have pending liquidation orders. And so for the full bailout, again, there's a tier 1 and a tier 2. So for the
which one is tier 1? Which one is tier 2?
Yes. Tier 1 can be withdrawn immediately. The bailout is funded with government bonds. So at the time of withdrawal, the fund manager will actually liquidate those bonds to make a payout. So the Tier 1 component is a short-term portion of the fund. The Tier 2 is a long-term portion of the fund. And that will be paid over a 5-year period. But they can make withdrawals. The balance can be withdrawn every anniversary of the fund. The partial bailout pays a capped amount of 50,000 cedis. So that one, irrespective of the size of your claims, currently we are paying a fixed amount of 50,000. That all goes into Tier 1. So for those whose amounts are below 50,000, they are being fully paid out under the partial. Those above the 50,000, their balance, once the firms move from pending liquidation and pending court processes into the full scheme, then we'll recalculate their Tier 1 and their Tier 2 portion for payment.
So currently, if you were to add the partial bailout and the full bailout, how much has been paid?
So under the, how much has been paid, there's two things. One is the monies the government has provided.
Yes.
So the government has provided about 3.5 billion for the program. There's a remaining 5.5 billion that we asked out of the budget. So out of the 3.5, a portion of that, which is about just about 1 billion, is in the full bailout. Okay. So of that portion, 500 million was in the short term.
Okay.
Okay. And so on that side, I'll have to check and get back to you. But the total amount, about 84% of those who signed up have actually been paid.
Okay.
And
you know, I actually like the figures also. So 84% of them have been paid, but how much of it has been paid?
The actual value.
Yes, the actual value.
So about 1.7 billion.
Okay, 1.7 billion. Now that's the total claims validated. Okay, so total value of claims I see in the phase 1 is 1.7, then you get to the phase 2. But the ones that were validated, for instance, 1.1 in phase 1, 1.06 in phase 2, then 556 million in phase 3. If I'm to check the figures that you post on your website as of March 2021, it's less than $1 billion that has been paid. Have you made any payments after that?
No, so the payments really, well, as of March, so between March and now, we have made some.
That's what I'm asking. So between, yes, I mean, because your website indicated up to end of March.
Yeah.
And I'm saying between March and now, have you made any payments?
We have made payments. We have made payments.
How much?
I have to get back to you on the total payments that have actually been made. But the payments are ongoing as we speak.
Now, you say government is giving you 3.5 billion. You made payments about 1.1 billion in the full bailout. And when it gets to the partial bailout, you've made payments about, about 600 million. So it's about 1.7 billion. What's happened to the remainder of those funds?
So as we speak now, on the partial bailout, we've actually paid about 1.18 billion.
So there's been an increase from the last
600,
yes,
exactly.
Okay.
So let me, so we've paid about 1.18 billion on that. And then on the full bailout, we've paid about 980 million.
Okay.
So just a little under $1 billion.
Okay.
So in total, you're looking at about a 2.2 billion or so paid out of that. So that's the position of the payouts. This is as of last week.
As of last week. So what, 900 and something million, then 1.1 billion. So that's giving you about 2 billion. But the other question is, so government is giving you 3.5 billion.
So the government's 3.5 includes the long-term bond and the short-term bond.
Okay. So the long-term bond, I mean...
The long-term is still there.
It's still there. It takes 5 years before they they can get it.
Yes, it's as an amortizing bond.
Yeah, I get that. Great. But there's one other issue. So these firms had assets, right?
Yes.
What's happened to the liquidation of their assets?
So that's also progressing. Unfortunately, the firms that we obtained liquidation orders for were the smaller firms,
Okay.
which were not necessarily as small, so the asset base was actually quite small. That's why you're seeing the disparity, the 3 billion against 5 billion. But we progressed on the liquidation. About 55 million cedis has been recovered so far.
55 million cedis.
Yes.
And how many firms are we talking about?
So this is
34.
the 34 firms. Yes.
34 firms have been liquidated. They've had creditor meetings, but 5 have liquidation orders, but they are yet to have creditor meetings.
Okay. And from these 34, the amount, realized from their asset is 55 million.
So far.
So far.
Liquidation processes obviously take a while, and that was the decision, that's what informed us to implement this bailout. Because if you had to wait for liquidation, people may be waiting 3 years, 4 years before they're actually able to obtain proceeds to be able to be paid. So the process itself is run by the Registrar General, and what she does is she goes after the actual assets of the company, if it's landed property, if it is vehicles, if it is securities, all these have to be traced. Because these are investment firms, oftentimes they invest in financial securities. So if they are holding debt instruments from an SME, now we have to trace those SMEs, we have to find the business and then recover the funds that were given to them. If it was an equity investment, then obviously you have to find a buyer of the underlying asset, dispose of it, value it, find a mechanism for disposing of it, and then you realize the proceeds from that disposal.
Okay. Now, in going through their books and everything, if you look at their assets, by way of estimation, how much would it be?
Well, at the point of the revocation, these firms were in distress. When we revoked them, the assets they had reported to us was about 8.1 billion.
Okay.
Out of this 8.1, about 5 billion was in SMEs and what we call commercial paper.
Okay.
The remaining 3 billion, about 2 billion or so were pension assets, which were really not the firm's own assets. So you might say that there was just about 1 billion that, give or take, you can say for sure these are fairly secure assets. But as I mentioned earlier, that total pot is only a portion of it that we are now dealing with. The rest are still going through the court processes. And those are the bigger ones. You talk about Black Shield, you talk about Frontline. Those are still going through we are still in court trying to sort out the liquidation modalities.
Let me get you, Deborah, because you've been talking about by the time of the revocation, these companies were in distress. But they didn't go through distress all of a sudden. Your Act, Act 929, is very clear on the things that you're supposed to do. How come you didn't see these challenges coming and they got to that stage where they could not be salvaged or saved?
I think the steps have to be very clear, that these companies report to the SEC on a monthly and quarterly basis. So
were they reporting to you?
Some of them hadn't reported for a long time. So we didn't have up-to-date reports. And if you look at the revocation and the grounds for revocation, some of them were also not reporting accurately. And some of them had corporate governance structures that had totally gone down. So when you look at some of the things that took place, like they entered agreements with customers to pay them a certain amount, the SEC had put in place that if you're not able to pay people, let us know. So have a register. So before the customers come to SEC, we would have already heard from the company what is going on, but it wasn't being done. And it's at that point that we started having hearings for these investors to see what is going on in these companies. We had to understand because the companies were not reporting that information to us. So we had to find out through other means what was going on in these companies.
Now, for those that were not reporting, and I've been going through some of the, I mean, I've been reading that about Beige, for instance, to talk about how they're not submitting their reports. So at what point did you realize they're not submitting their reports? And after the hearings, what happened?
So when you're not submitting reports, we write to you, we penalize you, so you pay the fine, then we give you time to submit the report. So it's not automatic that the first line of action is revocation, no.
Did you penalize any of them?
We did penalize.
How many of them did you penalize?
Well, we gave fines to quite a number of them. But the thing is, if the company is in distress and not even operating, some of them were not able to pay the fines. So that's why the decision was taken that if they are having our license, they are not reporting, they are not able to pay fines, they are not paying investors their money, then there's no point in them still operating with the SEC license.
You talked about the fact that, and one of the things that came out from the banking sector cleanup was that people were engaged in what we term as creative accounting at the time. Now, when some of them submitted, records inaccurate records. When did you realize these? How come you couldn't see it?
No, when you submit the reports, there's an analysis process that goes on. So we have to analyze the reports. And one of the things you'd realize is at the time, we had over 120 fund management companies reporting. And the capacity of the SEC at that point was also challenged because we had about 10 people in that department supervising over 120 companies. So there was some mismatch in terms of capacity of the SEC. But when these reports came and they were analyzed, the firms were told that this is the challenge the SEC has with your report. So they were given time to resubmit and they were penalized. But some of them never corrected their actions and stopped reporting completely.
When did some of them stop reporting completely?
So we have some firms who by early 2019 hadn't submitted reports to the SEC anymore, but they had investor funds. So the SEC could not just go ahead and revoke without having a solution for their investors. So the first step, which is our mandate, is protecting of investors. So you have to have a plan for these investors before you revoke the license of the company.
You talked about a mismatch, the fact that you had about 10 people having to assess operations of 120 firms. Now, that mismatch that you talk about is a factor in contributing to your inability to probably get these information on time, right?
No, the submission has deadlines, so yes, everybody has
but your ability to go through and probably see all the inaccuracies.
I would say that affected the timing of the reviews. Also, our processes were quite manual. So they were submitting physical documents. So imagine you're an analyst with 20 different firms, financials before you, submitted, and you have to review them within, say, 2 to 3 weeks. Now, with an automated system, some previous analysis will be done. Red flags will flag up any issues, and then you can delve into the nuances of qualitative analysis. For now, what we had and what we are transitioning from is a physical system where they have to actually key in the numbers in Excel, do their reporting, physically send a letter to management for management's review. So that also leads to some lags. And that leads to challenges just by the sheer workload, because the same team doing this analysis is the same team reviewing new applicants.
Okay.
And also going on site to do inspections. And the same team also reports on data for the management's information purposes. So then you have a challenge where obviously your resource constraints also limits your ability to properly supervise the industry that you have oversight.
So you would agree when someone says part of the problem came from the Securities and Exchange Commission, also because at the time your processes were manually done, and if you were automated, you could have spotted some of these earlier. You agree?
That's a fair point. That's a fair point to make. And I think we are conscious of that. We've started the automation process. Actually, starting last year, the fund managers could actually submit their returns online. And that has helped in the speed in which we can do the analysis and turn around information.
Okay.
Just to add to that, I think some of the reports were also audited reports. So if you're working with a credible accounting firm that we all know and you're supposed to present some financials to the SEC. We also believe that that firm also has some responsibility in preparing a credible report to the SEC. So in a sense, there were different levels of checks that could have prevented some of the reports that we received.
But I'm sure the the banking sector cleanup would have told you that there were some of the auditing firms that did a few things wrongly, and they were punished as a result. Even instead of chartered accountants had to sanction some of these persons, because of what they did. Maybe that should have told you that even when they submit audited accounts, you also had to do your own cross-checking. Right? Great. So this evening we're joined by Paul Abebe, who is Deputy Director General of the Securities and Exchange Commission, in charge of finance, and Deborah Ajimfers, Deputy Director General in charge of legal. We're having a conversation about your funds. Many of you have been asking questions about where is the money? I mean, we're told we're going to be paid. We're told we're going to be paid. We don't seem to get anything. One issue that has come up, and I'd like you to take this, Paul, because you've gone to invest in these fund managers. It's a risk you're taking. Now, why is government engaged in bailout when many of these persons know right from the beginning that they are not guaranteed fixed returns in many of the investments, for instance, in some of the investments? Why are you paying?
Well, we also have a responsibility for financial stability, and to also ensure that there's confidence in the financial sector. The other part is also really investor education and investors being aware. And then another part would call almost like a product mismatch. So some of the fund managers, especially those affected by this revocation exercise, were guaranteeing returns. So the investors
shouldn't be doing that.
They shouldn't be doing that.
When did you realize they were guaranteeing returns?
No, I think back in 2015, 2014, the Commission actually issued a directive for fund managers to halt that practice.
They didn't do that.
They didn't do that. Some of them complied. But I think it was raised as an issue by the supervisory staff because they identified it as a source of risk. Because clearly if you're guaranteeing, your balance sheet should be able to support it. And the question also becomes that what if there's non-performance in your portfolio? Do you have the right buffers to absorb that loss? And is that the model that you're regulated for? And so when we came into office, we reinstated that directive. We gave people a timeline to comply. And we also did quite a bit of public education and engagement with the public on the need to address this issue. We called the fund managers together as well and informed them that this is the measure that we're putting in place to differentiate the sector from the banking sector. And in a sense, you have some banks who are also in capital markets. Some banks are listed. Yeah. But when you talk about fund management, they manage a portfolio of securities.
Sure. And
they manage it within a certain mandate. And that mandate has to be clear. So given some of these challenges, the discussions with government focus on the need to address this issue. In some jurisdictions, you have what we call an investor protection fund. That is set up for when there are challenges of this nature, where there's a failure on the fund manager to act in a certain way, but there to seed it with funds from the marketplace. In Ghana's case, we didn't have any such protection scheme. And given that some of the crisis the fund managers faced was coming from the banking sector challenges. So there was a need, if you're bailing out the banking sector people, there's some clear contagion effects that had to be addressed. Even as Bank of Ghana was taking its actions, the SEC also had to step in and ensure that the customers who were exposed to some of these malpractices, in a sense, are protected to the extent.
I'll get back to that bit, but let's stay on the point that you make. In 2014, thereabout, you informed some of these fund managers that they were engaged in things that they are not supposed to do. From 2014 to 2019, some of them did not stop until you revoked their licenses. Within that period, what did you do?
No, so I think if you noticed, we started suspending some firms. I think in 2018, we did a few suspensions. We wrote to firms to actually halt taking deposits before we did the revocation. My colleague mentioned the hearings. So we called them in to explain their business model. And so to that extent, I mean, we are a regulator. We engage in dialogue. Certain things fall within our regime, but if we find that people have broken the law, some things will be referred to the Attorney General for prosecution. So that process is also ongoing. And clearly, we have to go through these processes. We follow the rules that control our activities. And I think the point you've made also brings out an issue we are dealing with now, which is the nature of our Act. As to the remedial measures that we have within the Act. And in this crisis, we found that if you find a firm in contravention repeatedly, they were very limited. It was either revoke or suspend. But the workout mechanism wasn't clearly spelled out. And so we found the need to do a review of the Act to address some of these issues, because you found the person guilty, you've written to him, he says, I'm trying to fix it. You find that he's still doing it, you write to him. Between then and when you actually revoke, there's not much activity you can do, actually, because what are you going to do? Do you appoint an administrator? Do you call the creditors together and do a restructuring of the business, right? And so those things are mechanisms that typically you should have in a corporate setting, but even at the time, the company's law rested on the Insolvency Act in the downside. And now we have the CIRA, the Corporate Insolvency and Restructuring Act. So that also gives us additional tools that we as a regulator need to embed in our regulation, because our regulation also draws some of its powers from the Companies Act. We use that as a basis, then you add on additional protections because it's a regulated space. The Companies Act is for everybody. The Securities Act is for those who come to the regulated space. So then they face additional hurdles or additional actions that are required for them to operate in that space. So it's an area that requires attention as part of the reforms that we'll talk about in the course of this discussion.
Yes, we'll talk about those reforms. But for many people, yes, you've explained that these challenges were going. But I mean, I think as you would agree that as a regulator, also, your responsibility is to protect us, the investors in some of these funds. Yes, we're taking all those decisions, but eventually, many people were still going there and investing in these fixed return investments, and eventually, yes, there's a talk about settling, paying, but you do know that in many of the instances, like we talked about the long-term, bailouts, for instance, over a 5-year period, we're staggering it to ensure that you're able to get your money. Meanwhile, if everything was well, these persons could have gotten their money. That'll take me to another point now, because one of the questions that have also come up is, following all these revocations, whether you've been giving new licenses, have you done that over the period post revocation of licenses?
I think on the fund managers, we had a moratorium on giving new licenses because we thought, I think people think all we do is asset management, but that's just only 86 out of 248 licensees we have. So for fund managers, we haven't given any licenses. We've actually issued a moratorium. We did it for initially 6 months, and we've issued another 6 months. So on asset management, we are not issuing any new licenses currently. But in essence, what we've done is we wanted to also make sure that coming in, how do people come in? So what have we done? So we've issued licensing guidelines and conduct of business guidelines. So what we are saying is that this is how you can come into our space. These are the things that we require of you. And after you come into the space, this is how you should behave, because we had some directors of companies who didn't know what they were supposed to be doing. So we are saying this is the qualification and experience your people should have. And after they have that, this is what the board should do, give strategy direction, make sure employees have certain things. So there's a lot of new things that now we are requiring of the companies through the licensing guideline and the conduct of business guideline, which was issued in 2020, October.
Great, yeah, so you've talked about when it comes to asset management, how there's a moratorium on it, but which other licenses have you given over the period?
We have unit trusts, and then credit rating. So those are the three as at fourth quarter 2020 that were issued.
Great. You want to come in, Paul, before I go ahead with my question?
No, I think it's fine. I think to just add to Deborah's point, we also started looking at the regulatory sandbox just to address innovations that may come into the marketplace. And the need to review the licensing was also to allow us to start to implement the digitization process. Because again, your ability to do your work depends on the technology you use. Now we all use the mobile money and digital payments and how easy it has made from carrying actual cash. In the same way, the regulatory business also has to evolve and operate, I would say, on a digital basis, because that also makes it easier to interact, even for license applications. When somebody applies, the process we go through, the due diligence we have to do, the other agencies we interact with, we need to figure out how we connect to them in the digital space. Now we write letters back and forth, and if that takes a while to do that, in the interim, the person is either you're giving them an interim approval to go ahead, or you are holding on, waiting for the clearance from the related security agencies we deal with. So those dynamics and addressing those issues are also some of the reforms that we've done in that period that we're referring to.
We'll come to the reforms, but there's someone watching us right now, and he has his money not paid. One of the things he'll be asking himself is, tell me, when would I get my money? For those who have been paid partially, they ask the question, when would I get my money?
I think we just have to clearly put them into two categories. So for the full bailout, the 34 companies that have got that, the investors filed claims, the claims were validated. So they have been given what their balances are with the AM fund. So that is the fund manager, because the initial investment was an investment. It was something that was supposed to be over a period of time. So what we decided was that even in giving them their money back, we will use an investment vehicle, because the main idea was that the product itself was an investment, not money they were going to collect the next day. So the idea of using an investment vehicle was only in line with the original plan of the investors. That was the plan. So then they have an anniversary date. So those who in 2020 started getting their payments, and the next anniversary will be October this year, they'll get. So those 34 companies, at each anniversary date, they'll expect some payments. They have the full bailout. Those who have the partial bailout, as we speak, have only got 50,000 because the court processes are ongoing. And the question you asked, that why did the government intervene? I think it's a social intervention, because we did the analysis of all the companies affected and individuals. There were pensioners, there were orphanages, there were rural banks, there were all categories of people. So what the government said is that we want to help these people out of distress. We don't want to leave them on their own. So what we are saying is that the 50,000 they've got for now, as soon as the processes go through or a different policy direction is taken, they'll be informed, and then they will know how they can access the remaining funds.
And actually, since our last press release, we've gotten about five additional liquidations, actually. So the 34 is now 39. In terms of firms that are, and so those who we've gotten liquidation orders for will now be rolled over into the full bailout. And the process that we've put in place is that those who already signed up, so when you mention that people say they haven't gotten their money, it's important that they understand the process. It is not that the money is automatically paid out. You are given a claim ID, you go online, and you sign up for it. It's a voluntary scheme. So you either wait for the liquidation and get your money, or you go online. The sign-up has two steps. The first step is agreeing to participate. When you agree to participate, you get a message to go on and subscribe, or to go on and open your AM Fund account. For that, you have to upload some KYC, because while you may have brought your documentation for the validation process, the process of paying, I just to make sure that you're the right person. Some people give power of attorney. Some people had corporate accounts, so you have to make sure that the signatories who are presenting themselves for payment are the right people. the last thing we'd want to do is to pay to the wrong people. So they have to go through that process to be onboarded. So at the point of one, signing up, if they have challenges, or if they find that the details there do not match their name, oftentimes people are in such a hurry to access the funds that they agree to it. And then at the payout stage, there was an issue with the name and the account number, because the ID they brought does not match what was filed on the claim form. In situations like that, we have to hold the payment until it is manually reconciled. For those who have challenges, I think on our website we have some numbers there, and we will give them out before this meeting is over. But if the people are having challenges, we have mechanisms for addressing their challenges as well.
Okay, but I mean,
let me just...
Yes, come on.
I think we also have to explain that the bailout was also sensitive to people. So pensioners who are above 60 are actually given a full bailout. They don't stagger their payments. So there are certain categories that were given.
They don't have the anniversaries where they have to.
No, they don't have anniversaries.
They're all in tier one.
So they're all in tier one. They get their money. So it was taken into account people and the years to retirement, institutions. Some were given more than the 50,000 because like rural banks have other people depending on them. So you cannot give a rural bank 50,000. You get what I'm saying? So it wasn't a blanket application to everybody. So just to say that there were some things taken into consideration, even in the payment of the government bailout. It was sensitive to people. And
if I decide that I want to be part of tier one, what happens to me? Even though I may not qualify, say I want to be part of tier one.
No,
Pardon?
tier one, full.
No, it's within their rules. So I think what she's mentioning is that if you go on the bailout website, bailout.rgd.gov, there's a presentation which lays out the scheme that Mr. Jennifer is mentioning, which says that for everybody, 70,000 in tier one. For the pensioners, it's 100%. For financial sector institutions, they are getting 50% of their funds in tier one. And that includes the rural banks, it includes the savings and loans and some of these entities. And then it also includes the SEC entities because they might have exposure to the industry. Then for other companies, they're getting 20% of the funds paid in the tier one. So that is the framework. That is the sensitization that we had to balance to ensure that the various segments...
And if I decide I want 100%?
Oh, it's not up to you to decide. This is a government intervention. It's government's decision to make. And that is the approach that we are adopting. And
Winston, the worst case scenario, if you could have lost everything. So government.
But you've also admitted that part of the, some of these persons were doing the wrong things, and you're doing a social intervention. Through no fault of mine, I put my money in there, and it's happened like that. So the social intervention, the person providing it is saying that I can do it under these conditions. So that is why you sign up to it. You don't. It's not mandatory. So because you have two options, either you sign up and say, I want the government intervention, or you wait for the official liquidator, who is the Registrar General, to recover assets, value them, sell them, and give you all the money. So in the creditor meetings, we make these two options available to all investors, that these are the two options you have, either to go with the government bailout, or you wait for the official liquidator to recover assets, value them, sell them, and give you all your money. So that option is available to people. You don't necessarily have to go with the bailout. Okay, so we've talked about all the processes that have led to the current situation in which we find ourselves. You've been telling us about how much you've been giving by government, and also talked about the assets that you've been able to recover, 55 million. Let's get to what you have done, because we've admitted here that some of the challenges could have been prevented, could have been avoided if a few things were done properly. What have you done ever since you had to go through the revocation of these licenses and the cleaning up of the sector? So just to highlight some of the things that have been done. As Mr. Abibio said earlier, our Act 929, was passed in 2016. Yeah. And the regulations were before the Act, because the regulations were with the previous Act. So we had 2001 and 2003 regulations, and very rigid regulations. So what we did was to go through stakeholder discussions
go through Parliament to amend these regulations. And what have we replaced them with? That's what I talked about, that we've come with stricter licensing requirements. So before you even enter through the door, there are things that you have to do. There's experience required, there's qualification required, and once you are in, what do you do? So the conduct of business is very clear. As I said, we are finding out that some directors didn't even know why they were sitting on those boards. So there'll be training of directors even before they take on their roles. So those two guidelines. And then we realized also that the related party transactions were very, very problematic. So now before you do that, there's a cap, and then the requirements of going through approval are much more stringent than they used to be. So then we've put all these things in place to make sure that there's no recurrence of this activity. And another thing is investor education, because what we've realized is that some people didn't even understand the products they were being engaged. So we've actually put in the conduct of business more of a KYI. So know your investor, know where they stand in life. You can't take a 65-year-old man and give him something that you're investing that will give you returns in 10 years. You know their situation. So we are asking for more engagement, more transparency from the fund managers, because in some cases, there wasn't even a signed agreement. There wasn't enough transparency. So these are some of the things we are doing on the law and the framework to make sure that these things are minimized in the future.
I'll get back to you shortly. We have to look at some of the things you're doing, not just in the law also, but in other processes. But that'll be after these few messages. I'm Winston Amwa, and tonight on Upfront, we're finding out more about the financial sector cleanup, particularly when it gets to the fund management firms. And we're joined by Paul Awabi, who's Deputy Director General of the Securities and Exchange Commission in charge of finance, and Deborah Jimfra, who is also Deputy Director General, Legal. We'll be right back. Right, so welcome back, and thank you very much for staying with us. This is Upfront on the JoyNews channel, and tonight we're having a conversation about the financial sector cleanup, particularly with the fund management firms and the Securities and Exchange Commission. They are here to help us understand what they've been doing. Many of you have asked for your funds, and they've been telling you what's happened to those funds. About 2 billion of them has been paid, 8.3 billion validated out of claims of 11 billion. So they're expecting to pay an additional 6.3 billion more. Let me get to you, Paul. And so what have you done? We know all these challenges. You're supposed to be solving them. What have you done now?
So I think we've mentioned some of the reforms and the guidelines we've introduced. The other dimension is really to, one, do public education, but also to encourage deepening of the markets. So some of the things we've done involve market development. For instance, we supported the introduction of the Commodities Exchange, which gives those who are interested in agriculture to participate, because there are financial investors who may want to play on agricultural products. Not necessarily to own stocks, but to actually own maize, to own actual agricultural goods. So that's one avenue that we've created. We also did a bond market diagnostic study. Now, if you look at some of the issues, this guaranteed return issue, a question comes up that if you want a fixed return, if you want a guaranteed return, how do you get it in this market? How accessible, one, is the treasury bill market, is the corporate bond market, even the government bonds. Government also issues long-term bonds. So making that accessible so that you on your phone, from the comfort of your home, can sign up to corporate issuances, which you do your own analysis and you can subscribe. But when the fund manager also buys a bond, he can build a portfolio for you and tell you that this is the portfolio that I have built for you, so that you know what goes into your fund. It's not that you put your money into a black box and you don't know what's happening. All you know is 10% or 15%. So that's important. We also introduced what we call private funds guidelines, which is a new product. What we saw was that some of the fund managers were investing in equity of SMEs. Now, when you invest in an SME, the skills and the structure and the governance requirements are quite different. You need to understand the operations. You need to have the capacity to go on site and look at what they are doing. And you have to understand the financials and their cash flows. Now, do your workers have that capacity? So we've introduced this product that requires that those who want to manage private funds come through the commission to get a license. We'll do an assessment so that when people are going and a person says, oh, I am investing in SME, you have to ask them, are you duly licensed to do that? Do you have the requisite capacity? And then what is inside the portfolio that you've built for me? We also introduced what we call real estate investment trust guidelines. So again, in our economy, housing and real estate plays a big part. And some of the fund managers actually put their monies into real estate. Real estate is a good asset class if you have the financial capacity to go in there. If you have the long-term funds, because you have to commit. And the day you need liquidity, the value may not be the same if it's an emergency versus if it is a comfortable withdrawal. So introducing these guidelines provides a range of products that the financial sector can then invest in a more structured format, greater accountability, and greater transparency.
Okay.
So that makes the fund management business, I would say, a bit easier on the market operator side, because then they have some frameworks. I'm either doing listed equities, I'm either doing REITs, I'm either doing a private fund, I'm either doing pensions, or I'm doing something else. So that's something else we can now interrogate on a much more specific and deeper basis, right? So that you, the investor whose money is there, you can ask the fund manager, where have you taken my money to? How have you invested it? And how did you make that investment decision? I mentioned the digitization effort as well. We started that in 2019, actually. By 2020, we started a beta version. We are pursuing that as well. And it's very important because what we are doing as part of our regulatory regime is to migrate from a compliance-based supervision framework to what we call a risk-based supervisory framework. So you look at the risks in the industry, you still look at the compliance requirements. They start to meet all those compliance requirements. But now you apply what we call risk weights to the various dimensions of it. And that helps to allocate our resources more efficiently. Okay. It helps us to delve into the problem areas. Otherwise, it's like spreading yourself too thin. Where are the problem areas? Where are the risk buckets we see? So that we can be more efficient as a regulator. Clearly, you mentioned that we had some challenges as well. And we acknowledge that. Financially, we were under-resourced. Our structure, where we operate from as well, is actually a temporary building. So we cannot even hire as many people as we would want, even though we need to hire people. If your office space is limited, that becomes a challenge. So we're actually working very hard to get a new structure, and the mechanisms are in place. We went through a process.
You still don't have that?
We still don't have that, Winston, unfortunately. But we're working on that. And that's also a very important intervention that we expect to have.
Let me just do this.
Sorry, the last thing was that part of the challenge is also the vision for the market. What kind of market do we want to have? So along with that, we launched the Capital Market Master Plan, which is the first master plan. There were other financial sector development plans that were broader, covered insurance, covered pensions, covered banking, and capital markets was in there as a smaller component. With the Capital Market Master Plan, it covers the entire capital market. It's focused on the areas that we have oversight on, but it also spells out some responsibilities that some of our stakeholders have to contribute to the development of the market.
Let me just ask this because we need to be wrapping up in a minute. What's happened to the Black Shield case? Because we know there are lots of funds locked up in there.
So I would say that Black Shield and the SEC are in court on two fronts. So one with the official liquidator and one with the SEC. So Black Shield, after the revocation, they appealed to the SEC, they lost, and they're in court fighting the revocation itself. The official liquidator went ahead and served them the petition to wind up the company, and they are also in court on that. So there are two cases on the Black Shield issue.
Okay. Well, that's all time would allow us. Thank you very much, Paula Babu, and thank you very much, Deborah Ajimfra, for joining us here on Upfront on the JoyNews channel. Folks, thank you very much for watching. My name is Winston. I'm on behalf of the team. Thank you so much for joining us. A happy Father's Day to all of you in advance. Catch me tomorrow on the Super Morning Show on Joy 99.7 FM. Have a lovely evening.